Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm so excited for you to join me today. We do this Passive Investing Made Simple boot camp. It's a skills boot camp once a month to help you deep dive into a specific area of building a skill so you can become a more formidable passive investor. So if you haven't done so already, make sure to check out passiveinvestingwithwhitney.com. There, you're going to get access to my free ebook and checklist, helping you get invested into your first or next passive real estate deal. You'll also get access to all of these wonderful masterclasses and boot camps that we do here at passiveinvesting.com, and you'll get priority access to our open deals. And guys, if you're here live, we have 3 open deals for you right now. We just recently opened a multifamily deal, so check that out for sure. And if we have time at the end, maybe we can save some questions there. But guys, if you're here, this is your first time joining, welcome. Again, my name is Whitney Elkins-Hutten, and this is the whole reason why I invest in real estate. This is me and my crazy crew. I started off investing in real estate back in 2002, completely by accident. Grew a live-in, flip, and house hacking portfolio. Did really great at building equity, really lousy at building cash flow. So then transitioned that portfolio into 36 single-family homes, and then eventually bought a 52-unit apartment building in partnership, and then hit my next ceiling achievement, which is, you know what, we need, well, for one, we had our beautiful baby girl at home, but one, we needed more cash flow. And, having 36 single family properties, trying to manage a multifamily building just really wasn't cutting it for us. I needed to figure out how to go bigger, faster. Now, I did 2 things. I invested actively, became a general partner in real estate. Then I also took all of that cash flow from my day job, what I was doing, and funneled it into investing in other people's deals. And, really when we kind of figure out which allowed me to reach financial freedom faster, the passive investing really amplified our cash flow. And, here's some numbers here. Over the course of 10, 15 years in the space, we have over 6,500 multifamily units, 2,200 self-storage units, 15 express car washes, a myriad of other investments. But it allows us 100% control and freedom on how we spend our time. And so, yes, I spend my time here with you. I'm super passionate about teaching people about financial freedom, how money works, how to invest, how to keep it, how to pass it on. Maybe you've seen my new book, Money for Tomorrow, how to build and protect generational wealth with bigger pockets. But this is what I love doing. And guys, we can help you do that here at PassiveInvesting.com. We even, have over $270 million of loans deployed in our rehab wallet funds, well over 1.4 billion assets under management, and extremely strong returns to our limited partner investors. Now, guys, we are going to be talking today about how to create an investing plan. Okay. Now, this is not financial advice. Okay. This is we're going to be going through some mechanics and math so you can kind of figure a lot of these pieces out for yourself. That way, if you work with a financial advisor or a tax strategist, you can bring these numbers to them, right? You're telling them what you want your portfolio to do for you rather than them telling you what plans they have for your money. This is extremely important. But I want to make sure that this is not financial advice, not legal advice, not tax advice. Okay. So, and again, if you haven't already, if you're joining this or watching this on YouTube or listening on your favorite podcast player of choice, and you want access to more education like this and to see our open deals, join passiveinvestingwithwhitney.com. All right. So the first thing that we need to learn how to do is actually create an investing plan, right? And I know that sounds funny. You're like, hey, the title of the webinar is creating an investing plan. Yes, we need to actually plan the work, not jump to the end work. How are we going to deploy the capital? Okay, execution is part of it, but we need to actually sit in the space where we're thinking. Okay, we need to allow time to think about these things. Okay, now I spend a lot of time educating people on how to understand their goals, their risk, and timeline. We are going to recap a little bit of that today, but if you're interested, go to passiveinvesting.com. Dot is spelled out D-O-T, com on YouTube, and there you can access our previous master classes and boot camps, and especially the boot camps about how to assess your goals, risk, and timeline. Okay. And that's a great place to start. But why have an investing plan? Why do you need to actually sit down and think about it? Okay. I just got off the phone with an investor who was like, hey, I need help. Help me figure out like how to make this switch from stocks, bonds, and mutual funds into private equity real estate. I'm all over the board. I don't know what to do. Well, that is the exact reason why to have a plan, because if you don't know where you're going, any path is going to get you there. All right. And if you don't have a plan for your money, I guarantee somebody else will. Right. It's like going to the doctor, right? You're the nail, and the doctor is trying to figure out if you're the right nail for them to hammer, especially if you're going to see a surgeon, right? That's what they're trying to do. If you have capital to invest and you're talking to operators, that operator is just like, hey, I got a deal. Hey, why don't you come be in my deal? Whether it's a fit for you or not. So if you don't have a plan for your money, I guarantee somebody else does. Okay. And your investing plan will actually inform your due diligence process and keep you from making rash or bad mistakes. So if you have a plan now and you incorporate that plan into your due diligence checklist and process, okay, if you think about it now while you don't have a deal in front of you, okay, you're going to make better investing decisions. Okay. You're going to be able to say no until you find the yes. All right. So Zoom is being a little slow these days. So let's wait for Zoom to catch up here. Okay, cool. All right, so what's the first part of your investing plan? And I want you guys to workshop this with me. So if you're here live, open up your Q&A box. We have to understand our goals. All right. Now we have a whole webinar, a whole boot camp around understanding your goals, risk, and timeline. So we're going to go through this pretty quickly, but I want you to go over to that Q&A box and drop in there. Answer the question. Do you believe in real estate as an investment vehicle? Okay. That's the number one question. Okay. If you do not believe in real estate as an investment vehicle, okay, private equity real estate probably is not for you. But most of us here fully understand the power of real estate. We understand that it can help preserve our capital, give us cash flow, help us build equity, and give us pass-through tax benefits and take advantage of leverage in ways that the stock market just cannot help us with that. So let me know if real estate is a vehicle you believe in, and then let me know what your goals are for your portfolio. Okay. Give me your top 3 goals for your portfolio. And here's some things here. What do you need your portfolio to do today? Does it need to preserve capital, create cash flow, create equity for you, create pass-through tax benefits? Do you need it to leverage lending to amplify your returns? Okay. Do you need inflation hedging? Do you need just diversification? Go to the chat box or the Q&A box and let me know what you need from your portfolio. Okay. Awesome. We got some questions coming in. Cash flow, awesome. Equity, amazing. See, and that's the thing. I just 2 answers right there. One person needs cash flow. The other person needs equity growth. This is why it's so important that you put together your own plan. Another person chimed in, all of the above, right? I see one of the top mistakes that I see investors make is that they borrow somebody else's investing plan. They hear somebody smart and they're like, hey, I want to repeat what they did. I'm going to borrow their plan without thinking what their goals are. Because, right, if one person's primary goal is cash flow and the other person's primary goal is equity real estate, and they borrow each other's plan, they're going to be really disappointed with the outcome of it. So you have to do this work for yourself. All right. And it doesn't have to be complicated, right? You can do this along here with me. If you are answering these questions along here with me, Okay, by the end, you're going to have like a half page or full page document really helping you, think through what you need from your portfolio and where you're at today and like how to close that gap. I had somebody put in equity growth, wealth protection, tax minimization. Okay, so they need equity, capital preservation, and tax benefits. Okay, so once you have those goals, you want to order them as well. Okay, put them in you can't put 1A, 1B, 1C, 1D, right? We literally have to order which one's most important to us. Okay, and the next question we have to answer is we have to understand our timeline. Okay, let's be realistic. Where are you in your investment timeline? Okay, are you in the accumulation phase, okay, of your investment timeline? Are you in a transition phase? Maybe, okay, like accumulation phase, it doesn't always necessarily line up with age, okay? But if you have like 20 years until you retire, you can probably go another one or two real estate investment cycles before you have to, prepare for retirement. Okay, that would be like kind of like constitute an accumulation phase. If you're within, say, 10 years of retirement and you need your portfolio to solidly produce just cash flow for you, you might be in a transitionary phase where you have to think about your goals, your current goals, differently than your future goals. All right. And then are you in a cash flow phase? Are you in that point in your investing timeline where you're just like, hey, it would be really cool if I could swing for the fence on a deal and take advantage of wonderful equity growth in maybe development deals, but I actually need reliable cash flow coming in on a monthly basis. Okay. I love one person. Isn't it everybody's goal to make loads of money? Actually, no. I think everybody's goal is to make money in the best way that matches what they need at this time in their life. Yeah. But I can see why you would say that. That's super funny. Okay. So now that we understand your goals, we understand your timeline, now you got to understand your risk. Okay. So remember, most people think, and this is generally true, that the lowest risk produces the lowest value, lowest equity growth, but fewer losses, which generally can be true. And that the higher risk is generally associated with higher equity returns, but might actually, if you produce higher losses. Okay. Now there is a way to mitigate this in the middle. Okay. I'll direct you back to our underwriting boot camps to help mitigate that. Take things that could produce high returns for you and actually mitigate the losses on them. Invest in assets where all those loss potentials are mitigated. But what I want you to think through right now in relation to your investing plan, how do you create this investing plan? I want you to think in terms, not so much as due diligence, but I want to think what would keep you up at night. Okay. So, is it paused or reduced or suspended distributions? Is it a certain type of business plan risk? Like maybe, maybe you're just like, man, if I invested on a property that was right on the coastline that was subject to, hurricanes every couple of years, I can't take that. But I can invest in the Midwest or in the mountain regions because I understand blizzards and snowfall and ice, right? Like for me, I don't invest in the Midwest where there's lots of tornadoes. That just scares the bejeebies out of me. So understand, and there's various other business plan risks, but you have to understand for you, what are those things that keep you up at night? I want you guys, again, to workshop this with me. Go over to the chat box or the Q&A box and put in, what are those things that would keep you up at night? Okay. I don't want you to think in terms of annoy you or just be really a Debbie Downer, but just if this happened to an asset in my portfolio, my anxiety level would go through the roof. Okay. Maybe capital calls, right? Capital calls happen for good reasons. Capital calls happen for, not good reasons. Maybe you're just like, I would not be able to, withstand a capital call. Ooh, you jumped ahead of me, but somebody put in fraud. Yes, fraud. Like, somebody just being, a, dirty, rotten, no good person and running with your money, right? That type of fraud. Or is it just loss of capital? Would that keep you up at night? Okay. Go to the Q&A box or the chat box. I want you to think through these things. Okay. I think all of us are trying to mitigate, a lot of these things in our portfolio. I know investors right now that are just like, I will not touch this type of loan or this asset class with a 10-foot pole after the last 12 to 24 months. Like now that's part of their own due diligence thing. Somebody said a capital call would tell me I may have picked the wrong sponsor. Okay. Again, capital calls happen for a variety of reasons. But if the capital call sounds like if the capital call, came through for business planning or maybe, fraud or lending or some lending issues, maybe, yeah, that falls in your due diligence. What you want to do here is align the risk you are not willing to take with your goals. Okay. All right. So the last piece of this is understanding what you can control. Okay. When we talk about how to create an investing plan. So we know our goals, we understand our risks, or we talked about our timeline a little bit. We understand our risks, but we need to understand what we can and can't control. Okay. And this is where it's super important for you to create rules for yourself now. That way, when you have that hot deal sitting in front of you, you can actually go, does it meet my rules or not? Or does it only meet them 90% of the way? And now I got to make a judgment call. Am I going to go in this deal or not? So your rules, what can you control, right? You control your goals, right? I like assessing deals based on those 7 pillars. Does it preserve my capital, create cash flow, create equity, tax benefits? Is it using leverage wisely? Is it actually inflation hedging for me? And, is it with a reputable operator? Somebody I know, love, and trust. Okay. Does it match my timeline for investment? Okay. Is it, eliminating the risk that I cannot stand to take? All right. And then you also get to, as a limited partner investor, get to control who you invest with, where you invest, in the deal and asset class you go into. Okay, that is what you get to control when you invest passively. So make sure that you have rules for yourself. And this is where a lot of people put together their due diligence checklists. Okay, those questions they ask operators. Okay, how are they reviewing the market? How are they reviewing the deal? And they're customizing it to what they need to see. Again, create rules now for each of these exposure areas. And again, don't borrow somebody else's rules. Okay, that might be a good primer. It's a place to start, but don't just take somebody else's checklist. And it's one of my pet peeves, people joining investment groups, and they download a checklist from that investment group, and they never tailor it to what they actually need. Okay. And remember, there's never a perfect balance. Okay. Especially when it comes to deals and asset classes, you always have to, especially in private equity investing, you have to look at what the market's giving you. All right. And we'll talk more about that here in a little bit. Okay. So now that we've kind of got the basic principles that you need to start having in creating your investment plan, let's start getting into some math. Now, we're not going to make this complicated at all. Okay. So if you guys are expecting to see calculus IRR returns for me, we're not getting into that. We want to give you some basic math that can get you 80-85% of the way there. Okay. To understanding how do you need to think through your portfolio. All right. So back in December, I did a goal setting retreat, 2024 goal setting retreat. And so in there, we covered how do you understand your financial milestones? Okay. What do you need for financial security? Okay. That is, do you have enough money in the bank account today to cover 1 year's worth of expenses? Okay. And that is just like bare minimum, roof over your head, food on the table, keeping the lights on, heat on, that sort of thing. Then financial vitality was having enough money in the bank to cover financial security plus some living expenses, okay, making life a little bit more comfortable for 1 year, okay? So those are, part of your savings plan, okay? And that you should have a line item in your investing plan that I will always keep X amount of reserves to make sure I hit financial security and vitality always, okay? I'm not going to deplete those reserves, okay? Then we get into the fun stuff where we start switching from having a dollar amount sitting in the bank or reserves, and then or in some sort of liquid note asset. That's also a cool place you can keep them, or like in a cash flow life insurance policy. You can keep those reserves there too. Then we start thinking about how do we now transition and start building that passive income that comes in on a monthly or quarterly or annually basis. Okay, and that's where we start transitioning to thinking, what do we need financial independence for? Financial independence, and that's to cover your current lifestyle today. Okay, cash flow, equity growth coming in, whatever, that money coming in that will cover all of your expenses today. And financial freedom is your desired life. Okay, do you want an extra house, an extra car? It's super funny. Every once in a while, I see somebody's financial freedom number be inverse from their financial independence number, meaning that they're living too large today and that they really want to streamline down to live their optimal life. But maybe they've got kids and they're doing a lot for their kids. Maybe they're working a job that has them traveling a lot and they have expenses they incur there. So, and then absolute freedom is, do you want to own a basketball team? Do you want to go to own an island? Do you want to rent an island? What are some of those crazy, out there type lifestyle choices that you want to add into your plan? Now, it's super important that you think into these numbers, whether you want to, have all of these milestones in your life or not, because they're going to inform where you are at on your financial journey. And as you move from milestone to milestone, it's going to change the numbers, the math for the remaining part of the equations I'm going to show you. Okay. So how do you understand your blended return on invested capital? Okay. Here's, if you're tracking your portfolio appropriately, and we're gonna do another masterclass here soon on tracking your portfolio. And if this is not something that you're doing currently, you can also go back and watch a masterclass that I did about a year ago on tracking your portfolio, but we're gonna redo that for you and add some additional bells and whistles. How do we get at this number of what our current portfolio, what kind of income it can produce for us on an annual basis, is simply looking at the currently invested money that you have to invest, okay, free to invest, multiplied by the blended investment rate. Okay, so you might have an investment that's yielding a 10% cash on cash. You might have something that's yielding a 3% cash on cash. So you need to look at the blended rate across all those investments. And that will help you understand what your current annual income is, right? That's where you're starting off today. Okay, and then you can peg it to one of these investment milestones. Okay, so that gives us where we're going at today. Now, simply, if we know what we need to get, so maybe we need $7,500 a month coming in for financial independence, and that's what we have today. Fantastic, thumbs up, we're there. But if we want actually financial freedom and we need $12,500 coming in a month, okay, I got to up my game. I got to do one of two things. Either I need to get a higher return with my currently invested capital, or I need to layer on more capital at my current blended rate. Those are the two numbers that we get to affect here. That's why tracking your portfolio is super important. Okay. And knowing where you're at today, knowing where you want to go to, is going to help inform your investment plan. Because if I've got to now close a gap of $5,000, I need to do so and keep in accordance with my goals, my risk, and my timeline for investing, right? Now, here's some math to show you that it is indeed possible to actually, you know, achieve financial freedom in 10 years or less, quite frankly, with passive investing. And this is just off the cash flow alone. If you're, if you got your, investments are producing a blended return, a preferred return, blended return of 7%. Okay. Now remember here, preferred return does not actually mean that's what it's delivering. You want that blended cash on cash return coming to you. Okay. You might, this is just one example of an investor started off initially first year, and it got invested at $500,000 and added $100,000 over the course of 5 years, actually the course of 10 years. And then, after 5 years, their investments, they just continued to reinvest the cash flow that they had coming in and the equity growth. And in 10 years, they're producing $138,000 in cash flow a year. And then again, we build the plan might look linear to you, but we get exponential growth over time. That quickly jumps from 138 up to 181. And of course, if your blended return goes up, okay, our numbers are going to just change. So here our assumptions were that there was a 7% preferred return, in this case, cash on cash. We're assuming a minus 2x equity multiple on invested capital after 5 years. Okay, so if assets start cycling out earlier, better, okay, for this particular plan, and that this investor is reinvesting all the proceeds through year 10, right? So I want you to go over to the chat box. One more slide. Now, remember, investments are going to start cycling out. Okay. So as investments start cycling out, you need to constantly go back and look at your plan. Okay. So I do this on an annual basis. I don't wait 5 years for an investment to cycle out because I'm constantly reinvesting and trying to compound my returns. So on an annual basis, make sure all of your tracking for your portfolio is current and up to date, and that you're continuing to adhere to your rules, your investing rules. Now, here's the thing. You get to change your plan at any point in time. You get to modify your plan as new information comes in, as you build new relationships and investing relationships. So make sure that you understand that, how your goals are shaping out. Okay. If you're moving it, from accumulation phase now into transition for retirement, your goals, 3 years from now might change. Okay. And that would be ahead of potentially your first asset cycling out. So you will need to start making those small little tweaks. Understand your timeline. We, kind of connected the dots there, making sure that as new information comes in, like, is there something that it's occurred that you're just like, yep, I don't want to do that anymore. I need to mitigate that. Or I was super mitigating for this particular risk, and it's really not that bad. Maybe I just need to plan for this. Like if we have one investor here that really doesn't want a capital call to happen, but maybe they just set aside reserves in case a great asset needs just a little bit more money to get across the finish line. Okay, maybe that's one way they then mitigate that risk. Okay, and then as assets start cycling out, I would always have the operator kind of re-interview for their spot. Is that somebody you want to reinvest in? I know a lot of investors that will just automatically jump into 1031 exchange for tax purposes, but take a step back as the investments cycle out. Like, hey, how is this operator doing? How have they been managing the asset? How have they been communicating with me? How have they been managing and being a good steward of my money and my investment in tough market times? Is this somebody I want to continue to do business with? Okay. Again, remarket as the market allows. And then remember that markets and investment horizons will change over time. So be sure to adjust your assumptions. Guys, if you're here, if you're joining on YouTube, if you are listening on the favorite podcast player of choice, remember, join us at passiveinvestingwithwhitney.com and get access to our future masterclasses and bootcamp sessions. If you're here live, don't go anywhere. We're going to start our Ask Me Anything session. Question came in your 10-year model to financial freedom, what was the amount of your starting capital? This was just in this particular case, and this is actually, a situation that, I talked to investors about. They were like, I have about a $500,000, $300,000 to $600,000 sitting in the stock market or a cash account. That is, I would like to get out of the stock market. Okay, so I put in here $500,000 to kind of kickstart this. This is not required, right? This is where you just want to, again, this is to show you the mechanics of it, that if you are in this situation, maybe you have a windfall of money, or like an inheritance, or you just sold a rental property, or you're transitioning out of you got a bonus from work, like a sign-on bonus, or you're getting you can liquidate some of your preferred stock. I have one investor that has a ton of preferred stock at their company, right? People come into general windfalls, but this could be a great way to jumpstart an investing plan. But you certainly don't need to have this at all, right? Somebody wanted to take a smoother ride and just invest 100, they're starting 20 years earlier and they just want to invest $50,000 to $100,000 a year, they could do that too. It would just take a little bit longer. But I would say majority of the people that I run into are new to private equity real estate. They've got something sort of built up, some sort of bucket of funds somehow, from either their day job, their work, other real estate, or from the stock market, and they're like, hey, time out. I want to get all these perks that real estate offers. So they kind of jumpstart the boat, and then they like trickle in dollar amounts over time, kind of like dollar cost averaging, really. Right, there's there's a set of returns that you might earn in multifamily real estate from assets in 2017. It's going to be a different profile from assets invested in 2019, and it's going to be a different profile of assets that are invested in 2024. So you can essentially kind of dollar cost average across some of these asset classes, just like you would in stocks, bonds, and mutual fund. What other questions do you guys have? I think the number one question that I get from investors is, okay, they can see the path of investing in real estate, but they don't think of it as a business, right? And what do I mean by that? Okay, we've been trained to invest in our 401ks just out of our paycheck, a couple grand a month, maybe, $20,000 a year. Let's just say that you're investing in your 401k. And that's it. We just do that. And if we write it out over time, we're going to have a bucket full of money to retire off of. Same thing can happen in private equity real estate. It's just that we have to understand at what point in the timeline are we coming in on. Okay. Also, can we add, build private equity real estate like a business? And that's where I was actually going with that, which means I'm constantly reinvesting my cash flow and my equity growth to supercharge my growth for a period of time. So if somebody came in and they wanted to invest $500,000 and they got annual distribution, return on that at $35,000, and then they said, thank you very much, I'm going to go on a vacation, buy a boat, buy a new car, send my kid to college, that's going to slow your investing plan. That is okay. You can do that. This is your money, right? But just know, if you ran it like a business and you're starting up your business, you're going to want to have a period of time where you're constantly reinvesting that capital back into the business so you can get this snowball effect faster. Okay, so think about, again, that needs to align with your goals, risk, and timeline. So think about what that means to you. What other questions do you guys have? Was this useful? What was your aha for today? Go over to the chat box or the Q&A box and let me know. Yeah, you're very welcome. You're very welcome. But let me know your aha. I want to know what was most useful for you today. What was something you learned? And then also, like, what was something, maybe a question that you're hoping to get covered, and maybe we can take time to dive into it today. A question came in. How do I get over negativity about investing in real estate deals after one deal soured? Yikes. Yeah, that is a great question. I would want, okay, there's the mindset piece, and then there's the skills, and then the network, right? Okay, so, and actually I'll back that up further. So like what, remember to go back to like what you want. When you're setting a goal, you need to answer 3 questions. What do you want? Why do you want it? Who do you have to become to get it? Okay. So if a deal is souring, or like, something happened to it, you got to go back and remind yourself, why am I even in this game? Like, what do I want? Okay. And here's the thing. For those of you who are my landlords here, it's not a matter of if you're going to have an eviction, it's a matter of when you're going to have an eviction. Okay. So the longer you're in passive real estate, or really any investing at all, it's not a matter of if you're going to have an investment, go sideways or plateau or stumble a little bit, or even go completely south. It's a matter of when and how you respond to that. So go back to remember, what did you want? What was your initial goal anyways? Okay. And then why do you want it? Attach it to that emotion, because we have to have that feeling. So go back and revisit that feeling. Okay. And then get into the who do you have to become to get it, right? If you're just like, man, I got an investment, it's soured a little bit. Okay, but I really do want financial freedom. That is super important to me, because I want to be able to do what I want, when I want, with whomever I want, and teach my kids to do the same. Okay. So now you've recentered yourself, and I know I'm doing this super fast. And then it would be like, okay, what do I need to change about my mindset here? Okay. Am I operating in scarcity, or am I operating in abundance? Okay. Is the world, do I believe the world is conspiring for me or against me? Okay. Maybe this is, take a step back. Maybe this was a bad deal. Maybe you broke one of your investing rules. Maybe you got into a deal that didn't have the 7 pillars attached to it. Maybe you invested in a momentum deal when you really needed a cash flow deal. Okay. So take a step back and understand, where's your mindset, but also, go back to your rules. Did you violate a fundamental rule in that investment thesis? Okay. I've done that. I'll be like, oh, wait a second. I invested in this deal. It's not going how I wanted it. And oops, I got really focused on the returns and what somebody else was doing and the potential here. And I violated one of my investing rules. Or maybe you go, wait a second. Okay, I learned something from this. I need a new investing rule for myself to keep this situation from happening again. Okay. And then once you, again, talk, who do you have to become to get it? Revisit that mindset, revisit the skills, here being your rules, your investing plan. And then, okay, like if this truly isn't an operator you're going to invest with anymore, a deal that you're not going to go into anymore, or an asset class, how do you need to expand your network to accommodate, to add in new operators, add in new markets, add in new asset classes that do help you get what you want? So hopefully, AP, that helps you kind of understand how I would think through this. Can you speak on new developments versus value add for financial freedom? So let's talk about this. I'm going to go back to an earlier part of the slide. Show. It goes back to, what do you need from your real estate? Okay. And a combination of where are you in your timeline. Okay. If you don't need cash flow, and you have and you're not in a transition phase of your investing, or a cash flow phase of your investing, you're more in an accumulation phase of your investing, development deals could be an option for you, but you got to think about how it matches your goals. Value add tends to be a step or two down from development deals. Okay, so they tend to offer, now remember, development You might get capital preservation, depending on where it is in the development phase. You're definitely not going to get cash flow. You should be getting some sort of forced equity. You're not going to get any tax benefits. Okay, you may get amplified returns from leverage, maybe. You're not able to hedge inflation, okay? So you're giving up some of these wealth pillars. If that is okay for your goals, then knock yourself out, right? But for somebody else, they might be like, ugh, I actually need a little bit of cash flow, equity growth, pass through tax benefits, and I want to take advantage of lending. So then maybe value add strategy is more appropriate to them. Again, it boils back to your goals. Oh, Chris, thank you so much. Chris says, great info in the learning phase now. This is good on the goals to help get closer to actually jumping into the first real estate investment. All right. What would, oh, a few other questions in the chat. What do you think would be a good starter investment that are just getting into alternative investments? And so again, we got to go back to your goals, your risk, your timeline. Okay, make sure those line up. And here, the question actually goes back to, remember I said, don't borrow somebody else's plan. Don't borrow somebody else's rules. Okay, so we really do have to critically think for ourselves. Okay, now, that said, I will give you my opinion. Okay, my opinion is everybody needs a roof. Think about Maslow's basic needs. What does everybody need? They need a roof over their head. Okay, so that's always going to be in demand. We as Americans love our cars. We love our belongings. So self-storage and express car washes are kind of a natural next step for me on that. And also, you know, people need money for their businesses, okay, to continue to grow their businesses. You know, I also like debt for that, especially fix and flip debt, you know, on primary homes. Again, I'm trying to always think about how can I get to the core consumer? How many fish are in the sea that need that product? And then when you start kind of getting out, you know, expanding out from there, you're going to get in more momentum type investments, niche investments. Like not everybody needs a hotel. Okay. But we invest in hotels because we do see that, you know, a majority of people take vacations. So again, I would think through that, like what's most appropriate for you. Also, as a first investment, most people own the roof over their head. So it's not that big of a leap for them to go into like a single family or a multi-family deal, right? They get it. They were like, I understand why somebody would want to rent an apartment and why they would want to have a swimming pool there and a workout center and a playground for their kids. I get that. I can wrap my head around that. You know, we have a deal open right now that is a package of single family properties in the Houston, Texas metropolitan service area. Houston is booming. It is in the path of this development is right in the path of progress. I can wrap my head around people need housing and they need affordable housing. And, you know, they want housing that's clean, affordable, and, you know, a yard for their dog and their kid. Like, I get that. So maybe, you know, understanding, you know, that's another way to think about is what do you fully, truly understand? And then figure out how to invest in that passively. Okay. You know, what kind of unique competition do you bring to the table or unique skill you bring to the table? And all of us understand housing, you know, in some form or fashion. Somebody put in young couple. Maybe that was in relation to my comment. Let's see. How do you run due diligence on sponsors you invested with? Oh, okay. So the same way I would run due diligence the exact same way that if it's somebody that I've already invested with and I didn't actually do my due diligence, I would run the due diligence the exact same way that I would, and I'm going to escape out of here because I actually put a slide in the presentation and then I hit it. So let me pull that back up. Let me see here. Oh, hey guys, I'm still sharing. There we go. Okay. So this is, if you go back to the boot camp on vetting operators, this is one of the kind of the process slide that I pulled out of there. This would be exactly how I go if I realized I invested with an operator and I went, uh-oh, I need to get to know them better, or I need to go actually set up a process for myself. Again, go back and watch that video. But in a nutshell, I would make sure that I've actually had a call with them. Okay. And then I have reviewed fully all of everything about their business and that we're still aligned, right? Like what they do as a business actually aligns with my goals, right? So how would you be unaligned? If you invest with an operator that does only developments of hotels and you're just like, man, I don't know anything about hotels and I need cash flow in my portfolio and the development doesn't help me meet the cash flow needs, you're not aligned, right? You need to go find operators that help you do that. And then did you go through, with your operator checklist, like, do you have any follow-up questions from that call or from reviewing what they do? Have you talked to other investors before? That can be a great way to, understand, hey, am I in the business with the right people? And then schedule another call if needed. I talk to our investors all the time, some investors that have been with us 3, 4, 5 years, they're just like, hey, I want to check in and understand what do you guys got on the plate? Where are you headed with the company? And are we still aligned? I mean, that's totally fair. Okay. So if you haven't done that due diligence already, make sure to do that. I also want to share one other slide here. And this comes from Dan Handford's red flags of investing. Oh, I might have taken it out, guys. So make sure also the operators, when you vet them, are not violating one of those red flags of investing. So, one of the red flags is that there's only one operator, right? Like what happens if there's only one operator in that partnership? What happens if they unfortunately get hit by a bus? What happens to the team? Do they have a team underneath them that's ready to step up? Are the operators related, right? Like for somebody here that was like, hey, I need to avoid fraud. On your checklist, you would want to make sure that there's at least 2 operators and they're unrelated. Okay. That will help you avoid fraud. One of the many ways to avoid fraud. Are they putting GP catch-ups into their deal? That's another kind of red flag for us, as we invest. Are they putting refinances into their deal? If somebody invested in a deal right now in this market that had a refinance modeled into their deal, I guarantee the numbers are off. I guarantee it, right? So while a refinance might be part of the plan, but you want to make sure it's never underwritten as a must do in the plan. And there's several other like red flags there, but that kind of gets you, rolling on that piece. Being an accredited investor is a massive roadblock for most investments I like. How can we build our net worth to become accredited investors? Guys, there's a lot of things you can do, and I want to pull this up and show this to you. I actually just wrote a book with Bigger Pockets called Money for Tomorrow. I'm not sure how many of you here have actually gotten it. This is probably one of the most asymmetric purchases that anybody can make for their investing. And so, hey, somebody just purchased that. Yay. This will teach you about the rules of the wealth game. Like, how do you create wealth, right? If wealth were a game, what is the objective? What are the rules and what are the strategies? Okay, so for somebody who's trying to get to be an accredited investor, you need to learn not only about creating wealth, but also keeping it. Because if you mastered those two areas, you're going to be able to compound grow what you have and hit accredited investor status readily. Now, it might take you time, right? But if you can master those two investing rules. So there's a ton of things that we can go through, but Money for Tomorrow will really help kind of kickstart that for you. And also know, as a sophisticated investor, there are still private equity investments. There's ways to get invested in private equity real estate that don't require you being accredited. The trick is that they can't be advertised. So you're going to have to do a lot more legwork in order to find them. Ooh, somebody said, I started reading your book this last weekend. Great so far. Thank you so much. That's so kind words. Somebody else contributed, join a real estate investment club and group invest to overcome that hurdle of being an accredited investor. That can be true as well. You just want to make sure if you're investing as a sophisticated investor and really investing at all, whether you're accredited or not, you want to make sure you have the right investing plan, that you know your goals, your risk, your timeline, that you have your financial foundation set. Okay, you've got all those reserves that you need in place to weather any sort of storm, whether the market goes up, down, or sideways. That's why in Money for Tomorrow, we spend an immense amount of time on how to actually protect wealth. Because so many investors I talk to, they're focused on creating it and growing it. And that's great. There's one set of skills for that. It's an entirely a different set of skills to be able to protect it and pass it on. And that's where in my family, in investors that I've coached, and just what I see, those are the skills to protect it and pass it on are where most people are lacking. So, and believe it or not, learning how to protect your wealth is going to get you to be to that accredited status so much faster. Awesome. Well, we'll hang out for like another minute or so. Any other questions that people have? I know a couple of people are like asking me about their own personal like portfolios. That we don't really get into advising on that. Oh, thank you. Yeah, you're very welcome. So just wanted to acknowledge that those comments came in. But we're really focused on here, like how we're going to create and jumpstart that investing portfolio. Ooh, one other tidbit. For investors who are unclear if they are accredited or not, go to parallelmarkets.com and you can try to get a letter, right? If you're right on the cusp and you're unclear if you're accredited or not, go there. Doesn't cost you anything, and see if you can get an accredited investor letter. Is there a blueprint for staggering multifamily investments and generating cash flow? Yes, and I guarantee you it's wrong. So, because while blueprint is going to be forward-looking, and then you got to look at what the market's giving you. Okay, investing in multifamily real estate last year was super challenging. So if you were starting that blueprint last year, it would have been really hard. You wouldn't really have gotten off the ground, or you might have gotten into deals that really weren't that good, maybe overpriced or used the wrong types of lending, attached to them. So you have to look at what the market is giving you. It's super funny. I actually went on this journey about 4 years ago, and I fairly well networked in this space, and I called a lot of really smart people, authors, people that I'm connected with in the pod space, and I asked these very questions. What is your asset allocation? How do you think through this? What are your top investments today? And how do you look at your portfolio breakdown? Okay, I interviewed probably 12 different people. I got 12 different answers. And when I said, what is the perfect formula for getting started in passive real estate? They all giggled at me. Didn't laugh at me. They giggled with me. in that they were like, you have to look at what the market is currently giving you, and and go into the right assets, and kind of dollar cost average those over time. Okay, so you might have $200,000 or $500,000 sitting on the sideline right now, and you want to pump it all into multifamily real estate. Be realistic according to your rules. That's what we're talking about today. Whether you can get it all deployed there, or maybe do you need to, in the meantime, invest that capital into, say, a short, a liquid note fund. Okay. That's one of the reasons why we have our PIC debt fund. We hope investors, keep their money in that PIC debt fund and allow it to compound and grow in perpetuity. But we do know that people sometimes need a short investment vehicle to allow them to continue to get some sort of compounded growth on their investment, or even just a simple growth on their investment, while they're trying to, shop around for those other investments that they want to get into. So, all right, guys, we've got time for probably one more question, and then we'll wrap it up today. All right. Well, guys, if there's no more questions, thank you so much for taking the time to join me today, and also take the time to invest in yourself. We will see you next week on the Passive Investing Made Simple Masterclass, where we'll talk to Tom Wheelwright. And then also next month, which we will talk through some of the principles that are in my new book, Money for Tomorrow. All right, guys, take care.